Hello and welcome to Pro Trader Strategies market commentary for May 1st. We're finally got April behind us. That seemed like the longest year ever. But my name's Eric Wilkinson, and yes, you very well may recognize me as the Wolfman from mainstream media, where I've talked about everything from economic to geopolitical, and on top of that, market analysis. Well, I do the same thing in these daily market commentaries, but I layer on some option strategies I find to help us in our portfolio to increase that overall yield. Especially in bear markets, this is the time and the place to start implementing option strategies. But please remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, without further ado, let's get on with that economic and geopolitical stuff see how that's going to impact the overall markets. Well, across the pond, really not a whole lot to see there. Today, though, we did in the United States get PMI numbers, and we got our manufacturing PMI numbers coming in line with expectations at 36.1, expected to be 36.9. Now remember though, everything below 50 is contraction in the economy. Everything above 50 is what we want to see, and we're not getting that right now. That it would be expansion. But we got the ISM, which is the Institute for Supply Management manufacturing number. That came out a little bit better than expected at 41.5. That's our main number to look at, and it was expected to be 36.7. Albeit better than expected, still below 50, which, when we have unemployment at 22%, which is what we're seeing right now, that's the same types of numbers we saw during the Great Depression. And we're seeing some markets have 52-week highs. The equity indexes are very close to those yearly highs, which has gotten me a little bit of a conundrum. I've heard some people talking about, the newer investor has been coming in force because they're sitting at home and buying some stocks. Also, I think the algos are kind of driving this market a little bit frothy at this point. So I've decided to lighten up on some of my positions that I'm not too keen on. So we'll talk about that here in a moment. Another thing that we got as another silver lining, though, was construction spending came in at 0.9%. That was expected to be a negative 3.5%. So that would be kind of what, I would expect to see is construction spending really ramping down. But we saw that as a positive number, which is a little bit bizarre, to be quite honest. And then we got the ISM, Institute for Supply Management. Prices paid coming in at 35.3, better than the expected 30.7. All right, so let's talk about the overall markets. They are equities not looking so good. We've got crude oil trying to get up into that 20 handle. It did pierce above there early today. As we'll see here, we can check this chart out right there. We can see that the high was, where was the high? The high was 20.46. So we did pierce into that 20 handle, but it's got rejected almost immediately. Traded up there, but now we're starting to fall back down. I don't think that we're going to see much more of an upside here, despite the fact that we're seeing a lot of oil companies really start to pull back on their production. I mean, they are just dripping to keep those pumps kind of alive. We talked about this when they shut them in, then that means they are really at risk of not being able to turn that spigot back on. So they're kind of really at a very slow pace, as if they were getting a hurricane or something like that. All right, so then we've got the gold futures. They did fall below 1,700, and I talked about this. I think that is going to be defended quite vigorously. With the equities coming off today, we're seeing that market push back above 1,700 right now. Yesterday we did trickle down below there. Today, though, we're seeing the bulls come out and force and push that a little bit higher. All right, 180 handle being defended today. We're seeing that probably the Fed is coming in there. I've talked about this. We're seeing this line here get drawn in. Markets looking like they're just going to trend sideways for the foreseeable future. A break above 183 handle would be a little concerning, that we would want to go up and test the all-time historical low in interest rates. If that starts to happen, we're probably going to see some of that fall off in the equities. All right, so keep your eyes on bonds as they would push above that. That would be very negative for the equities. Then we've got the VIX. Looking at that 40 handle again. You know, the 40 is the new 20. So the market really trying to push above that 9-day simple moving average. As you can see, we popped above there. So people going out there and buying puts. As a matter of fact, yesterday in my daily market, or in my webinar, I was seeing a lot of skew when I was going through a different scenarios on stocks to add a iron butterfly in and around. I was noticing there's a lot of put skew in a lot of these equities. So that means that people are going out there and buying protection. That's another one of those little building blocks in my my fear gauge starting to ramp up here a little bit, that the markets may start to want to roll over at when we see these weak hands that are the newer investor coming in. The algos, those are real weak hands. They start seeing some weakness and they're going to slam on it. So today, 2 days in a row, we're seeing the markets in negative territory. Dow Jones Industrial Average peeling below that 9-day moving average, as we can see right here. Getting below that 50-day moving average, heading into a weekend. We know that the investors don't like to hold stocks over the weekend, and we see a lot of covering on Fridays headed into the weekend because of that unknown. Nobody wants to hold anything over the weekend. So markets are starting to fall below those 9-day moving average, which signals, you know, short-term weakness in the markets. And we have created higher highs, higher lows. Anything coming out this weekend could really impact that sentiment going forward. And we've got the NASDAQ off by 300 points. The E-mini S&P is off by 3%. All of the indices below that 9-day moving average. I've talked about this. I thought it's getting a little frothy. It's going to want to roll over here a little bit. How far down we fall is going to be the real question, and holding on to 2750 in the E-mini S&Ps next week is going to be very key. So keep that on a piece of paper somewhere, because we start breaking below that, it could start to get a little bit more ugly to be moving forward with. All right, so let's talk about a couple of things that I've done. Actually, let's talk about the E-mini S&Ps. Pretty terrible. You know, yesterday we did get the consumer spending numbers coming out, not looking too good. Remember, that was a negative 7.5, expected to be a negative 4.8. That was pretty much the wet blanket thrown on this market. Then Visa coming out and talking about how they were seeing a massive reduction in the consumer spending on their end, down 19% in April, and credit scores going down by like 30% or something like that. So all in all, very unwelcome signs of what's going on in the economy. And I think that that's really been the catalyst, that consumer spending number, Visa coming out and warning, and that is really making the market start to roll over. So I've decided to go in and pare back some of my MasterCard. I sold, remember, I'm long some of this MasterCard, so I covered MasterCard with some short calls at the 290 level, and that was headed in. I left that on going in through the earnings, because I was more than happy to get that called away. Now, they actually had some pretty decent guidance and beat on their earnings, so the market started rallying higher. But today we saw Visa really throw that market into a tailspin, so I decided to cover some of my MasterCard. I covered them at $270. Not great, but my average was much lower than that. All in all, I still have on some MasterCard with the covered calls now. Now I'm completely on the covered calls trade, which I still have on at the 290 level. And basically, it shuffled me out of my average on those MasterCards. And now I'm long at 270 with what I have remaining. So I'm gonna ride that out a little bit further. If I get a bit of a pop in here today, I might try and sell out some of the rest of those MasterCard. But right now, I've got the covered calls on, so I'm pretty happy with that. The other thing I'm trying to get out of is some of my MasterCard, or sorry, my Microsoft puts. If you guys remember, I did a couple of things in here. I was looking at MasterCard well in advance of their earnings. I sold some puts in there. I was happy to catch it because I believe that MasterCard is going to do very well going forward in this type of environment. But I'm looking to cover some of those puts because, you know, they've gone down quite a bit with that volatility coming out on the earnings. I've got a positive move in there. I'm going to cover some of these just in case we get more of a correction than what I would be comfortable with. And so I'm trying to get out of some of my 155 or all of my 155 puts. I originally collected $1.58. Right now I'm trying to pay 43 cents in there, which would be the low of the day. It's trading around 50 cents last I checked. So I need a bit more of a bounce in here for my Microsoft to get out of there. I'm going to leave on my 195 calls in there, despite the fact that they are very close, or well over 50%, but very close to making $1 on it. That's kind of where my wheelhouse is on that. If I can buy the 195 calls, I sold the 195 calls at about 124. If I can get those back for 24 cents, I might look to do that today. They're trading around 30 cents right now, so not really even close on those. And then finally, with Disney, I'm also looking to get out of some of my calls in there, and I got short in the May with the 130 calls that, you know, we're looking like I might get a bit of a rally earlier this week to have those be tested. But right now, those 130 calls in Disney are trading around 10 cents, and I'm trying to get out for just below that at 7 cents. I sold them for 50, trying to get out for 7 right now, but the market pulling back is going to help me a little bit. But that volatility that I'm starting to see here spike as the market starts going down, and that's where I've talked about where I'm seeing a lot of put buying going on. That's driving up volatility across the board, so it's not helping me with this directional move on my calls. So the volatility is kind of being offset by the downward move right now. But I'm pretty confident I might be able to, I'm pretty confident I can get out of those a little bit later today. So that's all I've got going on. The couple of orders working. I don't think I'm going to add anything heading into the weekend either. So other than that, I'm kind of going to be a wait and see kind of day, I think, right now. Everything else I'm pretty happy with, despite the fact that the markets are down across the board. I'm going to hold on to everything else. All right, that's all I got for you guys, other than check out this disclaimer. I'm not trying to give you guys investment advice. I may very well be wrong on some of my market predictions. All right, that's not unbeknownst. I do have a tendency to do very well on these option strategies that we're implementing into our portfolio because that's how we stay mechanical. So please check out the ways that we implement these options into our portfolio, and then we need to follow those guidelines, but implement it into your portfolio in your own way according to your own market analysis. All right, that's all I got for you. Have a great weekend, and if you can't take that, take it easy.